Inflation. It's a word that can strike fear into the hearts of even the savviest investors. But what exactly is it and why should you care? Simply put, inflation is the rate at which prices for goods and services rise over time. It's the reason why a gallon of milk that cost $2 a decade ago might cost $3 today. This silent thief chips away at the value of your hard-earned money, making it harder to afford the things you need and want. Imagine you have $1,000 tucked away in a savings account. But what if inflation is at 3%? That means that next year your $1,000 will only buy you the same amount of goods and services as $970 would today. In other words, you've lost purchasing power. Inflation is a fact of life, but that doesn't mean you have to accept defeat. By understanding how inflation works and making smart financial decisions, you can protect your savings and even grow your wealth over time. The key is to make your money work harder for you than inflation can work against you. This journey starts with understanding the different ways inflation can impact your financial well-being. Imagine this. You've diligently saved $10,000 for a down payment on your dream home. You're proud of your achievement, and rightfully so. But here's the catch. While your money sits patiently in a savings account, inflation is silently eating away at its value. Let's say inflation is hovering around 2.5%, which is a realistic figure. At that rate, your $10,000 will be worth approximately $9,750 in just 1 year. Now you might be thinking it's just $250, it's not that bad. But here's where the real danger lies, the compounding effect of inflation. Over 5 years, with that same 2.5% inflation rate, your $10,000 will have lost over $1,200 of its purchasing power. That's right. What you could have bought for $10,000 a few years ago will now cost you over $11,200. This is the insidious nature of inflation. It's a slow and steady erosion of your savings, often going unnoticed until you need to use that money and realize it won't stretch as far as you thought. This is why it's crucial to not just save your money but to invest it in a way that outpaces inflation. Remember, the goal is to maintain and grow the purchasing power of your money. So, we've established that inflation can erode the value of your savings over time. Now let's talk about how to fight back. The answer lies in investing your money in assets that have the potential to grow at a rate higher than inflation. Think of it this way. Your money needs to work as hard as you do. It needs to earn a return that not only compensates for the rising cost of goods and services but ideally exceeds it. This is where investments come into play. There are numerous investment options available, each with its own risk and potential return profile. Some popular choices include stocks, bonds, real estate, and commodities. The key is to find investments that align with your financial goals, risk tolerance, and time horizon. Investing is not about getting rich quick. It's about building long-term wealth and securing your financial future. When it comes to investments that have historically outpaced inflation, stocks often take center stage. Stocks represent ownership in publicly traded companies, and as those companies grow and become more profitable, the value of their stock tends to increase. However, it's important to remember that the stock market is inherently volatile. Prices can fluctuate significantly in the short term, driven by factors such as economic news, company performance, and investor sentiment. This volatility can be unnerving for some investors, but it's important to remember that investing in stocks is a long-term game. Think of the stock market like a roller coaster. There will be ups and downs, twists and turns. But if you can stomach the ride and stay invested for the long haul, history has shown that you're likely to come out ahead. One way to mitigate the risks associated with individual stock picking is to invest in diversified stock mutual funds or exchange-traded funds, also known as ETFs. These funds pool money from multiple investors to invest in a basket of stocks, providing instant diversification and reducing the impact of any single stock on your overall portfolio. Section 5. Bonds, seeking stability in uncertain times. While stocks offer the potential for higher returns, they also come with greater volatility. If you're looking for a more stable investment option, bonds might be a good fit for a portion of your portfolio. Bonds are essentially loans that you make to governments or corporations. When you buy a bond, you're lending money to the issuer for a fixed period, and in return, they agree to pay you a fixed interest rate, known as the coupon rate. Bonds are often seen as a less risky investment compared to stocks because their returns are more predictable. However, it's important to note that bonds are not without risk. Inflation can erode the value of your bond's interest payments over time, and if interest rates rise, the value of your existing bonds may decline. Despite these risks, bonds can play an important role in a well-diversified portfolio. They can provide a steady stream of income and act as a ballast against stock market volatility. Section 6. The power of diversification. Don't put all your eggs in one basket. You've probably heard the old adage, don't put all your eggs in one basket. Well, this rings especially true in the world of investing. Diversification is the key to mitigating risk and maximizing your chances of success over the long term. Imagine you invest your entire portfolio in a single stock. If that company experiences a downturn, your entire investment could be wiped out. However, if you spread your investments across a variety of asset classes, such as stocks, bonds, real estate, and commodities, you're less likely to be affected by a downturn in any one area. Diversification is like building a financial safety net. It helps protect your portfolio from the inevitable ups and downs of the market. When one asset class is performing poorly, others may be performing well, helping to balance out your returns over time. There are many ways to diversify your portfolio. The goal is to create a well-rounded portfolio that can weather a variety of market conditions. Section 7. Time is money. The magic of compounding interest. One of the most powerful forces in investing is the magic of compounding. Albert Einstein is often credited with calling compound interest the eighth wonder of the world, and for good reason. Compounding is the process of earning interest on your interest. When you reinvest your earnings, those earnings generate their own earnings, and so on. Over time, this snowball effect can lead to exponential growth in your wealth. To illustrate the power of compounding, consider this example. If you invest $1,000 today at a 7% annual return, and you reinvest all of your earnings, your investment will be worth over $2,000 in 10 years, over $4,000 in 20 years, and over $8,000 in 30 years. The earlier you start investing, the more time your money has to compound. Even small contributions made consistently over a long period can grow into a substantial sum thanks to the power of compounding. The sooner you start investing, the sooner you can harness the power of compounding and watch your wealth grow. Section 8. Weathering the storm, managing market volatility. Investing in the market can feel like navigating a ship through a storm. There will inevitably be periods of volatility, with waves of uncertainty and fear crashing against your portfolio. However, it's crucial to remember that market fluctuations are a normal part of the investing journey. Just as a seasoned captain relies on their experience and tools to navigate rough seas, successful investors develop strategies to manage market volatility. One of the most effective strategies is to stay the course and avoid making impulsive decisions based on short-term market movements. When the market takes a dip, it's tempting to panic and sell your investments. However, this often leads to selling low and buying high, which can significantly harm your long-term returns. Instead, try to view market downturns as opportunities to buy quality assets at discounted prices. By staying invested and riding out the volatility, you give your investments the opportunity to recover and grow over the long term. Section 9. Seek expert guidance. The value of professional financial advice. Navigating the world of investing can feel overwhelming, especially with the constant influx of financial news and the ever-changing market landscape. While it's essential to educate yourself about investing, seeking professional financial advice can provide invaluable guidance and support throughout your financial journey. Think of a financial advisor as your financial co-pilot. They can help you create a personalized roadmap tailored to your unique financial situation, goals, and risk tolerance. A good financial advisor will take the time to understand your needs, answer your questions, and provide objective advice to help you make informed decisions. They can also help you navigate complex financial topics such as retirement planning, estate planning, and tax optimization. By leveraging their expertise, you can develop a comprehensive financial plan that addresses all aspects of your financial well-being. Just as you wouldn't hesitate to consult a doctor for your health, seeking professional financial advice is an investment in your financial well-being. It's about gaining peace of mind knowing that you have a trusted expert by your side, helping you make smart decisions to achieve your financial dreams.